Today, central banks are they beginning to panic? Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Today, I'm joined by Tarric Brooker. Hi, Tarric.
G'day, Martin. How are you?
I'm pretty good. How are you going?
Yeah, not too bad. Just watching the spin from low unfold. In his little hearing with, interest rates don't affect inequality and all that other jazz he's coming out with.
Well, look, I mean, he basically replayed what he said last week, right? That what happens over in the US is irrelevant. It's not going to happen here. And, rates are going to be long for low or low for long.
Well, it raises an interesting point, though, because if we can't generate wage growth, if we can't generate the conditions for inflation under the most ideal of circumstances, reversing that overseas migration, borders closed for a couple of years, $500 billion worth of stimulus commitments and all that. If that's not enough to create wage growth, I think that speaks to a rather serious problem within the core of the economy. And I would imagine it's related to the fact that household debt is just dragging so significantly on the economy more broadly.
Well, I think that's right. And the other factor I think that people have missed is, the unemployment rate is those available for work. Right? But there are loads and loads of people who are not available for work. So a lot of people, for example, who are self-employed, pretty much stopped looking for work, and they're actually out of the workforce. So a lot of people over 55 out of the workforce, they're not looking. So in fact, the unemployment rate is actually not representing the true state of play with regard to people who would perhaps like to work but are out of the system, right? That's another factor that, again, is taking the numbers to weird places.
It is. I think that you to sort of get a better read on things, personally, I like looking at the Centrelink numbers. Now, obviously, not everyone who is unemployed on Centrelink is looking for a job, but there are some pretty good independent analyses of going around of how many people are. And when you look at that, it's significantly higher than the number of people who the the ABS are counting as unemployed. So it sort of creates an interesting scenario. But by the same token, it's not like Australia is the only one with that particular issue. That is something that we're seeing around the world these days, with statistics not really being entirely representative of what's going on.
No, UK is a great example. So they're claiming a very low unemployment number, but it's only those that on effectively PAYE. In other words, you pay tax on the way through, right? Anybody who's not, so for example, self-employed people who don't actually pay through that system are excluded. And in fact, looking at the UK situation, again, the same situation. A lot of self-employed people, a lot of small businesses have just given up. They're out of the system, right? And over in the UK, they're suggesting that there's somewhere between 500,000 and 1 million people who were in the workforce before COVID hit, and they're out of the workforce, out of the system. And so the unemployment numbers are giving a false read as to what's really going on. And I think that's a really important factor, not just here, but in the US as well.
Well, it's an interesting one. I mean, part of the issue in the US as well is just how unemployment benefits work. You reach a certain point in, you've been, depending on, it varies obviously by state and locale, etc. But you reach a certain point and your unemployment benefits expire. It's not like Australia or parts of Europe where you can just keep claiming unemployment benefits infinitum. There is a time limit. And that's one of the things I think is really somewhat overlooked in the broader context of the US labor market and the US economy and just all that stuff more broadly, because I think it's really interesting that we spend all this time talking about all this other stuff, not, you and I, but just, the media more broadly. And we don't talk, very few people talk about the millions of people who've been booted off unemployment benefits, who are now basically forced to survive with nothing. Yet you'd think for a supposedly, heavily left-wing government, at least that's the way it's perceived in some quarters, that they'd be doing something like, I don't know, providing people with a permanent safety net rather than just, oh, hey, too bad, bye.
Well, that's right. And look, I think that, we will sort of get on with the slides in a second, but just to sort of come full circle, right? If in fact the RBA is now saying we will keep rates low until wages growth rises, right? They might be negatively surprised on precisely what happens with wages growth, right? Because of this other issue, that the real unemployment story is not the story that is being presented. And that for me is something which I think could be a killer argument.
It could be. I mean, personally, I just think that we're at a point in the economy whereby, there's just not, everything has just been so handicapped by the large levels of household debt. That's something that the Bank of International Settlements' research has gone into in detail. It's basically, once you reach a certain point, household debt starts to drag on the economy.
Yep.
And that is, I think, one of the major issues that we're facing. Because if you look at, say, for example, business investment, people like to look at it in nominal terms, which is just not the way to go about things. If you look at it as a percentage of the economy and you take away mining investment, which obviously ebbs and flows with commodity price cycles, it's just fallen off a cliff over the last 15 years. And that is what we should be looking at in terms of like long-term wage growth, long-term prosperity. Everything depends on businesses investing to make that better tomorrow.
Well,
it's not a lot to the government.
No, well, I agree. And in fact, the chart pack, I did a presentation on the chart pack last weekend. In there, you can see precisely that effect. If you look at actually the flow of business investment, particularly away from mining, it's absolutely nowhere. And if you look at productivity, it's nowhere as well. So, this economy is not positioned particularly well, despite, of course, all of the spin from everybody saying we've got a great economy and we're wonderful economic managers. The truth of the data is saying something rather different. And I guess on the data question, we should get on with your charts, otherwise we'll be out of time.
It wouldn't be the first time. All right, let's get started then. Okay, well, this is quite a nice little meme to kick off with, because yesterday the US CPI surprised to the upside, and that is what we'll start with this week. Now, US inflation, it was expected to come in at around about 7.2% year on year. It came in at 7.5% year on year, which really, really rattled the markets. It sent the US 2-year rocketing up to its highest level since the end of January 2020. And basically, things are now getting really, really interesting in terms of rate hikes being priced in. And I would also add that this is going to have some spillover into Australia, into the rest of the world, in terms of how soon we're going to see a rate hike cycle kick off. The economist Warren Hogan was on Twitter today saying that there's about a 50-50 chance of a rate hike in May, and I don't think he's far off the mark.
No, it's interesting. And Bullard, of course, in the US came out later on the afternoon in the US time and said, the Fed may have to actually lift 1% over the next 3 meetings, or indeed even between meetings, right? So the stock markets, which were already going down, so took another dip lower as well, because now, of course, the markets are saying, oh, this could be quite serious. And that 10-year bond rate, it's above 2%.
Yeah, exactly. It went from 1.95, 1.97, all the way up to 2.05, which is, perhaps, for some of you, I don't need to tell you, but for those of you who don't know, that is a very, very large move within the bond market. I believe Steve Van Meter had a great chart about that the other day, in terms of the size of these moves in the bond market are getting quite large. And also, just on the point of the stock market, yesterday, as of last night, when we saw this big CPI print, these, stocks dipping, it was the second largest participation by retail, in stocks in a single day ever, according to JP Morgan.
Yep.
They bought more than $1.7 billion worth of US stocks yesterday. And that's really saying something. It says that, that retail is continuing to buy the dip, and they may keep buying the dip all the way until it, potentially ends poorly for them, because historically retail ends up holding the bag.
Yeah, I think that's a really good point. And if you look at over the last 18 months, a lot of new investors came in, with all the government money and everything else. They've gone into cryptos, they've gone into stocks. And interestingly, a lot of the professional investors are still saying, well, we're on the sideline because we think there's a a further downward move here before we actually get, seriously back in the market. So buying the dip, and there's a lot of noise on all the social media channels about you should buy the dip, buy the dip, buy the dip. Retail investors, I think some of them are going to get wrecked.
Well, yeah, I mean, and inevitably that's what will always happen with retail eventually. But it's one of the things I just think is really interesting in all this is that I really don't think that the market is pricing in the level of hawkishness from central banks globally, particularly the Fed. I mean, they are now talking about 100% chance. Market futures are now pricing a 100% chance of a 50 basis points hike in March. That should be sending stocks to the woodshed, but it isn't. I mean, don't get me wrong. We've seen the Nasdaq come off 2%, a little more than 2%. We've seen the S&P 500 fall, 1.5%. But it's not the sort of big falls that you would associate with. Oh crap! There's going to be a half a basis point, rate hike at the next Fed meeting. So, I mean, obviously markets are markets, and they can be irrational for longer than we can stay solvent. But I think that there is definitely a repricing of risk and a repricing of stocks that needs to happen, in my view. And I will say that is just my opinion. It is not financial advice. Please, for the love of God, do your own research.
Absolutely, do your own research. But there was one little chart that I saw, I might put it up here, where Bloomberg showed that, in fact, the Nasdaq's fall, which was quite significant, they'd actually regained half of the fall before yesterday, right? Which shows you that these markets are not actually reacting the way you would expect if the risk was fully understood or factored in. So somewhere there is still a belief amongst many people that the Fed is going to save the markets. I think that's getting more and more unlikely given what we're seeing with this inflation and everything else that's going on. But who's right? The markets or the central bank? Interesting question.
I think it very much depends on your timeline. In the short term, no, the Fed can't save the market. If it would have to take a massive dive to be able to justify them doing so. But in the longer term, if inflation does get under control, say, towards the end of the year or the start of next year, then that's another story. But by the same token, if people are right, if some of these predictions about 100 basis points in the next 3 meetings are correct, I think the market's going to have some rather serious problems long before then.
I agree. I think that I always said 2022 was going to be the year, right? And it's proving to be.
Well, it's certainly going to be an interesting one. Now, this is an interesting one because it shows basically where the inflation in the US is coming from. Now, obviously, as you can see from the chart, that there's quite a lot of a contribution there from energy, and unless oil prices continue to rocket higher, that will eventually begin to fade. However, the thing that I find the most interesting about this chart is it shows that services inflation by itself is now above the Fed's target. The Fed's target is a flat 2%. So anything above that in theory, should prompt rate hikes, and has historically. But the thing that I find fascinating is that with services inflation now above that on its own, it's only going to take a little bit of extra inflation from goods or from energy or from food or from whatever you like to keep that figure high, and to keep pressure on the Fed to keep hiking even into what could potentially be a deflationary slowdown.
Yeah, I think that's really important. And in fact, if you look at the numbers overall, there was inflation everywhere, and some of the moves were huge compared with a year ago. So there's a real big question about whether it is just supply chain. But actually, if you look carefully, Tarric, a lot of this is still supply chain related.
It is, and I've got you covered on the next slide.
Hey, right, let's go.
Okay, now Goldman Sachs did an analysis of the US PCE, which is basically the Fed's preferred inflation indicator instead of the CPI, which strips out some of the more volatile things. And they concluded that about 1.4% of core PCE, which is now pushing about 5%, is driven by supply chain problems. Now, obviously, that might be a greater degree in the CPI because it does have the more volatile aspects. But it does go to show that, that the core inflation in the US, the things that people really need, are going up, and they're going up very significantly. And as you can see there from the red line, that it's well and truly high enough, in and of itself, without all the supply chain issues, to continue to prompt a hawkish Fed.
Yeah. And that they'll be looking at those numbers thinking, yeah, we underestimated it. It wasn't as transitory as we thought. It's more embedded. And of course, the other factor that is going there is wages are going up, but wages aren't going up as fast as inflation. So actually, in real terms, real incomes are going backwards.
Yeah, and they're going backwards at the fastest rate in decades.
Yep.
I was going to include that chart, but I ran out of room.
Yes, too many charts.
Pretty much. Okay, now this one I think is really interesting because some people have looked at it and they go, well, that's a sign of strength. US consumers are getting back on the credit cards, they're getting back on the buy now, pay later, and all these other different things. And spending, and basically we've seen about 4 years of spending growth crammed into about 9 months. Yet what it's actually showing when you pair that with the US consumer confidence data, you pair that with interviews that people have been, that various academic institutions have been doing with consumers to basically, get a more accurate barometer of where spending intentions and where attitudes and psychology is at, it shows that people are leaning on their credit cards in order to be able to afford to live. And that is not an uncommon thing. If you look at the period in 2007, shortly before the financial crisis, which is when oil prices took off, inflation took off, you see a very similar trend of that just rocketing of consumer credit as people turn to these forms of credit in order to just keep their household budget going.
Yeah, that's very important, Tarric. And I see that in my surveys too, that in fact those households who are under pressure financially with big mortgages are also the ones that are actually tapping their credit cards harder, using buy now, pay later, et cetera, et cetera. And I don't know whether you noticed, but last time around, the ABS guys said their data is not actually accurately reflecting the total credit exposure in Australia, so they actually didn't post some of the data because they're trying to work on it, because they're changing some of the methodology. They're trying to get a handle on the buy now, pay later element and some of those other credit elements. I think it's really important because it's quite clear to me that people who are in financial pressure will reach for more credit, because what else can they do?
Exactly. And one of the things I think is interesting is that this is the best. This is as good as it gets as well. This is, we're still, if you go across all the various support mechanisms, you talk about the credit being injected into the economy by borrowing, you talk about the government's budget deficit, you talk about state budget deficits. You put all that together, you're still talking about a couple of $2 billion a week in support being thrown into the economy. Well, it's more than a couple of billion, it's probably more like 4 or 5 billion, but it's money that wasn't there. Well, not all of it. Some of it was there, but most of it wasn't there prior to the pandemic. So if we're seeing stress, if we're seeing problems and people struggling, even with all this support in place, even with inflation only at apparently 3.5%, how is it going to be if inflation does continue to take off? If say for example they start pricing in rents closer to where SQM and CoreLogic are saying it, and we see inflation at 4.5% potentially. If you sort of impute the level of rental price growth that they're seeing, it's well and truly not out of the question. So it just goes to show that the underlying economy behind all the stimulus is not as strong or as robust as is generally thought of and frequently claimed.
Absolutely. And just one other question, of course, how big is the RBA's balance sheet now compared with when it was there? It's about 3 times the size now.
Well, exactly. And ironically, it's one of the few reasons that the government isn't really too worried about what's going on with debt levels at the moment, because so much of the interest that they pay, they give to the RBA, and then the RBA gives it back to the Treasury. So,
exactly right. Yeah. And Lowe was at pains to point out it's not so much doing more QE because they stopped yesterday, right, in terms of doing more, but it's the stuff that's already in the system, right? And remember that the Reserve Bank in some particular bond issuance has 60% of the total bond.
Yeah, which is a real problem for those things. Say, for example, like that 3-year bond that they spent so long targeting before the yield curve control blew up in its face. When they do, when that does roll over, it really does make you wonder, what is that going to further push the front end of the Australian bond curve up, which, for those who may not know, basically just means our short end rates going to rise even further, which is going to put even greater pressure or upward pressure on interest rates, which is exactly at the time that the RBA's term funding facility expires for the banks.
Yep.
So it's going to be a double whammy there for the government and for the banks, because they're both going to have to go to the bond market at the same time for a couple of $100 billion, and which could be interesting if they do elect to go for those short-term maturities again.
At a time when, of course, international rates will also be going up.
Fun times ahead. I mean, I do have some fairly significant concerns that that some of these three-year mortgages that people got towards the end of 2020, as in particular, that I may face a challenging time when it comes to refinance when the fixed term expires.
Yeah, I think that's right. And I put a tweet up earlier, actually, from someone I was chatting to this morning, who said, they actually didn't go fixed. They actually went for variable because they took the RBA at face value and said rates aren't going up until 2024. So I thought, well, that's good. We'll keep our rates variable to take advantage of that. Suddenly, 6 months later, it's looking as though it's getting a bit shaky. And unfortunately, they didn't have a huge amount of buffers, despite, of course, the banks were actually obligated to do the 2.5% or 3% buffer. But those are artificial. That doesn't really tell you the full story of the cash flow households. So I'm afraid that this is going to put a lot of pressure on a lot of people.
Indeed. Okay, now I quite like this one because it shows what the core of the US economy looks like when you strip away all the stimulus, all the support, and all the distortions that are created by the Fed and asset purchases and stock prices, etc. And it just shows that once you take away the transfer payments, which is basically all the various tax credits and stimulus and everything else that the US government's been doing, in real terms, households are significantly worse off than they were prior to the pandemic. And I think that really sort of speaks volumes about the true state of the US economy and the true state of the global economy. Because, if the US does enter a recession, it does struggle, they're dragging the rest of us down with them. Not that we're not going in that direction anyway, if those sorts of issues are realized.
Yeah, but the point there is that we've got a very similar situation here where effectively, if you took away all the stimulus and all the stuff that was done, and by the way, if you also take away the rating of superannuation and all the other things that were part of the kit that they threw into trying to save the economy, households would not be in a very good state, I'm afraid. And again, of course, averages mask. There are some fine, but there are some that aren't. And unfortunately, those that aren't is getting a bigger and bigger pool. Those that are in fine fettle are still supporting and holding up the economy. But the question is, how much longer can they go on doing that?
Exactly. I think that raises an interesting question. Like we hear Treasury, we hear Josh Frydenberg in particular go on about the $245 billion that households have saved since the pandemic started. Now, I mean, personally, I haven't seen the breakdown for that, but if it's roughly analogous to other nations, it's overwhelmingly held by the wealthy. Now, if you look at APRA's data in terms of household savings aren't being spent, unlike in the US where excess savings are being spent. So it's this, we're relying on this. It is the cornerstone of the strategy for the latter half of 2022 and into 2023. But people aren't spending. Now, we can speculate as to why, but the reality is if they don't, the economy has a problem as all that stimulus feeds through and as the sort of, I'm not going to quite call it a fiscal cliff, but just as the reality of the underlying fundamentals of the economy become clear.
Fiscal foothills, if not cliffs. But there's two observations there. One is, of course, some of that is in superannuation, because actually there were some people who were able to put more money into superannuation. The second, which means it's sort of locked away. The second is, of course, a lot of that wealth is actually in the shares, in the share markets, because they've gone up significantly as well. So when you actually look at accessible wealth compared with overall wealth, it's quite a different story. And, my data indicates that it's roughly, the rule of thirds. A third of households is where most of that savings is sitting. Hard for them to spend quite a lot of it, I think, for all the reasons we've discussed, plus the fact that you only need so many cars or so many TVs or so many, Down at the other end, you've got a third that really have nothing. And then you've got another third somewhere sitting in the middle who's still very much hand to mouth and trying to manage all of this moving parts. And that's where the cost of living and particularly the discretionary versus non-discretionary spending comes in. Because a lot of that middle group, the discretionary pressures that they've got now on spending are huge, even at these low rates. So overall, you might be able to aggregate up and say, well, there's a big pool of money. But when you actually look at where it's distributed and how it's working, it's not actually hitting the majority of the population, in my view.
Well, just on the point of, distributions and, the price pressures and all that, and that particular topic, one of the things I think is interesting is the price of oil. Now, people have said, okay, back in 2007, it topped out about $150 a barrel. But someone made a really interesting point in a recent research report I read, and they basically said that was $150 in 2007, $2008. If you impute global inflation on top of that, you're talking about an oil price in inflation-adjusted terms of about $220 to $230 a barrel, depending on which inflation metric you want to use.
Yep.
And if we get even anywhere near that, if we get to oil at $150 a barrel, it's going to create, it doesn't matter about all these other base effects that might reverse in the inflation statistics, whether it's in the US or in Australia over the next, 6 or 12 months. If oil continues its march to $150 a barrel, inflation is going to remain, and then it's entirely possible that the Fed and the RBA are going to be forced to hike into a significant slowdown, even as the economy falls away, yet inflation continues to rise.
Absolutely. The oil is the one to watch. And of course, there's still a lot of hedge funds piling in. They think it's a safer bet than many of the other things that are out there at the moment. And some of them, again, are saying, well, we think at 120, 150 is definitely conceivable ahead, particularly if we get the shenanigans in Eastern Europe all blow up and stuff. So it's very interesting to see how that plays out. And again, looking at my surveys, when I look at where are those cost pressures coming from, the price of fuel is right up there.
Well, someone made a good point about that on Twitter the other day. I forget who it was, but they basically just said that it's because it's the most clear thing that you see. If a pack of chips goes up 20 cents, a lot of people aren't really going to notice that. They'll notice that the headline grocery bill has gone up $10. But when you see that petrol station sign say $1.99 a litre, like the one I drove past yesterday, it just hurts you. It just hurts your internal wallet. You just go, oh, it's painful to look at. And then you think about, okay, oil at the moment is in the 90s. You think about oil at $150 a barrel, plus all the taxes and stuff that we face here in Australia that have that multiplier effect on the price of oil. And you're potentially talking about an oil price, a fuel price of, $2.50, $2.75, $3 a litre for fuel. I mean, can you imagine? I mean, obviously you can, but you can imagine what that would do to confidence.
Absolutely. And look, I'll make the other point about the fuel, of course. It is fixed volume, right? So it's per litre. So they can't do what they're doing in many other categories, is shrinking the size, So you end up with effectively a smaller package of the same stuff that you bought previously. So the price doesn't go up as much as you might otherwise think, right? But it's still there. It's less visible. But you're right. The fuel, it's there in lights, isn't it?
Yeah, well, exactly. And unless the ABS wants to decide that everyone's just going to start driving around in little toy cars with funny horns and stuff, it's just, that if oil
don't give them
rise,
that idea, they might do it.
Ultimate shrinkflation, eh? Oh, okay. Well, this is another one that's also a relatively unavoidable thing in terms of consumer perceptions. On a 6-month annualized basis, the US, which I think is a good way of looking at things because it irons out some of those base effects. Normally, I don't favor annualizing, but in this instance, I'm prepared to make a small exception. US food CPI up 8.3% on an annualized basis over the last 6 months, and that is just so damaging to households. And and that is what they're measuring in terms of what wholesalers are feeling. It's even greater. So if those wholesalers start passing on those rising costs to an even greater degree, then it's going to be an even more challenging situation for households. And on the left there, we've got the UN Food and Agriculture Food Price Index, which is very nearly at an all-time record high, unfortunately.
Yeah, that's very concerning, isn't it? And again, I see it in my surveys, the everyday stuff that people are buying continues to rise. There was a report the other day about meat prices have gone up dramatically recently. So this isn't sort of, exceptional expenditure. This is just bog standard expenditure. And these sorts of statistics really does underscore that.
Yeah, exactly. And it just goes to show how inflation is disproportionately hitting the poor and the lower classes, because, once upon a time you could go out, you could shop on special, you could get your half a kilo of base quality mince, which personally I favor, and you could get it for $4.50, $5, at absolute most. Today you're paying $7.50 for the same thing, and all you're trying to do is feed your family with an absolute of the most basic of the basic.
Yeah.
And that is really hitting people hard. And it also feeds into the perception of inflation, and that is, I think, why it's going to be such a challenge politically, both in the US and, well, for basically everyone, including Australia.
And I'll make one other point. I was reading something the other day, and they counted up in the UK the number of food banks versus the number of Maccas, right? And for the first time ever in the UK, there are now more food banks than Maccas. It's a shocking thought.
It is. I mean, although by the same token, when you have people, when you've got some banks telling people to rely on food banks to pay their mortgage, it's not really all that surprising. No. Although to go with a UK reference, you've also got the Bank of England governor telling people not to ask their boss for too large a pay rise.
That's exactly, having put the interest rate up and saying there is more to come, right?
Yeah, well, exactly. Inflation's rocketing ahead of wages growth in the UK. Wages growth has halved in the last 6 months, and is in a downtrend. And if that continues, it's not a pleasant thing to think about for them. Yet, the central bankers are all off in la la land, thinking, "Oh, please don't ask for a pay rise," because that's the real problem in all of this. It's you asking for a pay rise. It's not all the trillions of dollars we pumped into the economy and the stock market.
No, that's right. Well, it's a great. Again, I often use the term misdirection, right? Because they want you to look over there rather than over here, right? And just remind you again that in the UK there was a report. It was done by some very senior, people, including from the House of Lords, who were involved in the Bank of England in the 2007. But they said that the whole quantitative easing program and this whole, edifice that was built by the Bank of England and the Treasury, one, didn't achieve its objectives. Two, was putting huge pressure on real households. And three, they didn't see any exit path. Right. Yeah. And that report came out a few months ago. It was meant to be being debated. Conveniently, it hasn't been debated.
Wow, shocking. And just while we're on the point of inflation, I was doing a little bit of maths the other day, and I did that. And basically, if wages rise by 3%, the amount of cash being injected into the economy, increases by about $25 billion, give or take. Now, I thought that was a very interesting figure, because when you start to think about, say, equity mate withdrawals from homes, it's $93 billion. So I just find it a little bit grating, shall we say, that the RBA is going on about, if wage growth goes too much, we're going to have to start to talk about interest rates. We're going to have to start to talk about all this other stuff. Yet, if homeowners inject $93 billion, or almost 4 times as much, That's a-okay.
Yeah, and add to that again in those superannuation withdrawals.
Yeah,
That
well,
was a huge slug, right?
you've got superannuation withdrawals. You've got a $99 billion budget deficit that's
Yep.
being injected into the economy. You've
Yep.
got all this other cash, and yet it's wages growth. No, that's the thing we have to kill.
Yeah.
And I just think that's really interesting because I mean, I really like say for example, under MMT, the idea is that if inflation gets out of control, you pull back, you start to you raise taxes, you do the things that you need to do in order to keep inflation under control. Yet, can you see Scott Morrison raising taxes? Can you see Joe Biden raising taxes?
No.
Even on the wealthy who've amassed over $2 trillion, they're going to tax them on that in order to bring down inflation? I don't think so.
No, I don't think so. And, remember that there's a $16 billion war chest in the last budget, right? Which is basically what ScoMo will throw at the economy to try and bribe his way back. That's a lot of money.
The question is it a lot of money, though? Is it a lot of money? I mean, yes, obviously, definitively, if you look at it from a purely, a broad academic perspective, yes, it's an absolute shed load of money. You could do all manner of things. You could probably house half the homeless people in all of Australia with that amount of money. But is it a lot of money relative to how much people have seen flowing into their household coffers from the government in relative terms over what they've seen over the last 2 years? When you've seen all this cash flowing in from JobKeeper, you've seen all this cash flowing in from all these other different things. Is it, are they really going to be able to is it going to have the same effect as it would have done if ScoMo did that in 2019? And I don't think it will.
I think
sorry, go.
I was going. It's a really, really good point, right? Because we've already seen, that massive amount of stimulus being thrown to corporates that didn't need it, right? As JobKeeper was. They're all big numbers. But I would also make the point that 16 billion won't be spread equally across everybody, right? It will be wonderfully targeted into specific seats and to specific programs to try and actually attract just enough to get them over the line. And that's the other thing just to bear in mind.
No, absolutely. I mean, we've seen that with sports rights. We've seen that with the car parking funding debacle and the complete lack of the government responding to certain journalists' freedom of information requests.
Yeah, funny that.
Yeah, well, I got to say, people think that when you're a journalist, even when you're a journalist for someone like News Corp, that when you talk to people, they will answer. They will give you. They will answer your questions. No, it's not that simple.
No, absolutely right. And in fact, you can tell an awful lot when they don't answer the questions, right? Because that there's something there that's actually important, but they're not prepared to engage, which suggests that they know it's important.
Well, yeah, I mean, but yeah, I'm not going to go into specific details to not sort of drop anybody in it, but yeah, it's more common than people think.
Absolutely.
Okay, now this leads into what you were saying before, Martin, that basically, well, as you can see from this chart, that the wealthy hold more money in the US than the other four quintiles combined. So basically, the spending of the consumer economy is all up to them. And I mean, Jesus, 56 grand, that's a lot of money to be able to spend, but are they actually going to spend it?
Yeah, and it's interesting. That's basically top 20%, right, 60, 80. So it's basically by fifths.
Yeah.
Right? If you were to take that top 20% and look at it more granularly, you would find a horrible distortion, right? Because there's about 1% is, 100 times higher than the next 5%, right? It's remarkable, just the unequal distribution of wealth and excess cash in the US. It's quite similar here, by the way, as well.
Indeed, and I think one of the things that's interesting is that, as I was saying earlier, yes, US households are spending their excess savings. However, they're only spending at a rate of about 12 billion a month. Now, in an economy the size of Australia's, that would be fantastic. But in an economy that's worth well over 21 trillion US dollars, 12 billion a month ain't much more than a drop in the ocean. particularly with the backdrop of the fiscal cliff actually arriving and the level of government support coming to an end is far, far greater.
Absolutely. And remember, folks, that wages are going up more slowly than costs. So people are not just standing still, but they're already drifting backwards.
Yep, and and I would also add that that's also the case in Australia. Wage growth is going backwards, and it's expected to go backwards even in the RBA's forecasts, and they're famous for their wage growth forecasts until, at the very least, the middle of next year.
I know, shocking.
Okay, now this is what I was referring to earlier. There is the market, as of late last night US time, is now pricing 100% chance of a 50 basis points hike in March and a 92% chance of 6 rate hikes by the end of the year. Now, that is certainly going to put the cat amongst the pigeons. Now, personally, I think something's probably going to break before we get those 6 rate hikes, but who knows? Maybe we will.
Okay, so you've got to ask yourself this question, right? Why is the market pushing so hard? Right? I have a feeling that there are some specific positions being taken by some of the big players to try and take an advantage of any movement that happens. Right? And there will also be some on the other side of those trades saying, no, not going to be anything like that. So what I don't know is what proportion of this is actually driven by position taking and derivatives positioning rather than actually the underlying. My suspicion is an awful lot.
I think that's always a factor. In modern American markets, that's always a factor to some degree. I mean, you've seen that with some of the. I mean, I get it's insider trading. Let's not beat around the bush. That's been done by some officials.
Yes.
Government officials and otherwise. But I think it also just speaks of a bond market that is just furious with the Fed for getting so far behind the curve. I mean, you look at the inflation data and they could have been hiking in sort of May, June last year, even if they were just tapping it up by, 0.1%, just as a little bit of a shot across the market's bow. But now they've created this enormous bubble. Although, in fairness, if they deflate their enormous bubble, most likely with a prick and a bang, I mean, it'll probably address inflation, at least for a little while.
It might solve one problem, but it might create another.
Well, that's what central banks do. That's their job. Like in 2008, they were like, okay, we're going to solve this problem by engaging in quantitative easing and easy monetary policy. And now we've created this enormous time bomb. In order to address this enormous time bomb, we're going to allow it to burst, and then we're going to do even more QE and more stimulus and make an even bigger time bomb. And that's basically sort of the long and short of what central banks have been doing over the last 20 years. They just, like Krugman back in the early 2000s. Oh, the dot-com bubble blew up. We need another bubble to help power the economy. Oh, no, let's have a housing bubble.
Well, the fact is that we have had a perpetual set of bubbles throughout the last 30 years, right? And they've jumped from one to the next, the next, the next, the next. Each time what they've done to do that is to take rates lower and lower and lower and lower and lower, raising the debt ever higher, higher, higher. So those are the levers they're pulling, right? And the real honest truth that I think is probably going to come to bear ultimately is we will see rates coming back down again, right? Because this is all going to fall apart.
Absolutely. I mean, I still think we'll see negative rates here in Australia. I mean, well, at the very least, a zero cash rate here in Australia in the next 5 years, because things will break. It's the core fundamentals of the economy are not good. Yes, there are things that can and will power inflation. We will, say, for example, in the US, those excess retirements are going to continue to cause a tighter labor market than otherwise possible. The reshoring of supply chains will also create, further inflationary issues. Now, obviously, there are geopolitical things, like if we see a major schism, not just, the saber rattling and the yelling at each other over a table, but an actual schism between the US and China that causes an actual decoupling, there's another story. Maybe then the deflationary future, the deflationary factors will be overwhelmed by the fact that you're basically forced to relocate, most of the world's, supply chains for certain goods. But it does raise some interesting points. I mean, no, personally, I think, I've long held the view, like we talked about in that first slideshow. I mean, I think it was about May last year now. I think we will get inflation. We will get stagflation. Make no mistake, this is stagflation. You have negative real wage growth by a mile.
Yep.
And yet, in the end, when all the inventories build and and you're starting to see supply chains return to normal, whenever that may be, it might not be until the middle of next year, maybe even longer, you will see that deflationary impulse.
Yeah, and the point to make about that is that stagflation tends to be, can I use the word transitory? Yeah, I will.
Yeah.
So stagflations tends to be a phase to move to something else. And the question is, where do you end up, right? And I suspect deflation is probably where we end up.
Yeah, and the thing is, as well, is that this isn't demographically induced stagflation. This isn't, this enormous demographic wave moving through, like that was part of the reason what caused it in the 1970s, because of this huge wave of baby boomers coming in, buying their houses, buying all these goods, driving up the price of things with this excess demand. This time, the excess demand has been driven by stimulus, and that's temporary. It will end. It's just a question of when.
Absolutely. And of course, driven by central banks dancing with the treasuries.
Yep, exactly. Now, this one's interesting. The Chinese M1 money supply has contracted for the first time, and this is the year-on-year one, I might add, it's not just month-on-month, contracted for the first time in decades, or at least it may have contracted previously, but records before 2000 are a little bit harder to get the hands on. And basically, M1 covers cash, the bank deposits, and other at-call funding, bank products, and building societies, yada yada yada. So I just think that's something interesting to keep an eye on, because it's not exactly a sign of health for the Chinese economy if that is contracting at all. And it also just shows the sort of, maybe the People's Bank of China isn't going to be stimulating them all that much if they're allowing this to happen.
Well, they have said previously that they're going to be much more selective about what they do. And they've reduced some of the capital ratios and they've encouraged some more debt. But I think this is going to be really interesting, because the assumption that China's going to rescue us again is, I think, definitely overstated.
Well, I mean, I look at iron ore heading for $160 a ton, and I'm honestly quite skeptical that the fundamentals are there, because frankly they're not. The demand isn't there yet. Maybe it will be at some point down the road, particularly with the CCP Party Congress coming up later in the year, when Xi is confirmed as glorious leader for life. Could be confirmed as glorious leader for life. I mean, most likely will be, but. I think that's something interesting to keep an eye on, because if all this is speculation, as ironically the Chinese government has said in terms of the demand for bulk commodities, it could really hit Australia like a truck at the worst possible time, potentially in the run up to the election.
Absolutely, yeah. Timing is everything, and there's a few, and of course the property sector up there in China is still looking particularly wobbly. They still mess around with Evergrande and the other things, but really haven't solved that. So you have to say a few wobbles around there.
Oh, absolutely. Okay, now this is an interesting one. Basically, as inflation rises, as central banks are forced to become more hawkish, we're seeing bond yields rocket, even in countries that are heavily protected by the ECB buying, in some cases, 100% of net bond issuance. And you can see that say, for example, in the Greek bonds there on the left, you see the fact that in the last, what is that now, about 4 or 5 months since the start of September, yields have gone up from 0.5% to 2.5%. And considering how much more debt these countries have taken on, and how quickly things can get very challenging if the ECB is forced to become more hawkish and NQE and all that stuff. I mean, I don't think they will. I think they'll probably trash their currency before that happens. Things could get very, very challenging for some of these nations.
Yeah, and you notice, of course, that the 10-year German Bund went positive for the first time for a long time.
I did, and it's headed up to like 0.3%, which is just, I mean, it's kind of insane. I mean, it's like, oh hey, we get 0.3%, so we get zero inflation adjusted return over 10 years, even though inflation will eat that up in a single year. But I mean, that's the EU banking system and all that stuff, and that's a whole nother video.
The super central bank, absolutely.
Okay, now this sort of feeds into what we're talking about in terms of rates and stuff, and basically, despite the fact that rates haven't risen yet here in Australia, and the fact that even at the time of that survey, that the soonest one expected would be for August, according to, I believe it was Westpac, rates are, according to CBA's analysis, already weighing on consumer confidence significantly, and that's something that's going to prove really interesting, both as something that's going to feed into politics in terms of the election, but also how it's going to feed into consumer spending, because consumers haven't seen a rate hike in almost 12 years. So it could be, quite the shock to the system and quite the change, the psychological change that needs to be undertaken in order to adapt, which could, potentially cause quite some impact on consumer spending.
Well, it goes back to what I said, that conversation I had this morning, right, where people basically had committed to a large mortgage on the assumption the rates were going to stay low. Even the talk of rates going up is already changing their behaviour, right? Yeah. They're already saying, well, we better not spend what we were going to spend. We were going to do this, that, we're not going to now. We're trying to insulate ourselves from those future rate rises. And whilst people would say, well, look, 1 or 1.5% doesn't sound very much, you got to remember that when rates are so low, even small incremental movements in a mortgage rate has a huge financial impact when the mortgage is so big.
Well, indeed. I mean, if you go by, say, for example, the RBA's average, their data on the average variable rate that is currently being paid, a 0.25% increase is around about an increase of a little over 8% in terms of total in terms of total interest costs, and that's just one hike. Yep. So if you talk about, say, for example, say they raise rates by 1%, as some people are talking about them potentially doing by the end of the year, that's a 32% increase in the cost of interest payments. Now, one of the things I think is interesting with that RBA data is that obviously it's an averages masks things quite significantly.
Oh, yes.
But the thing that I find really interesting is the people on those variable rates, particularly people who've got those mortgages relatively recently over the last couple of years, who've taken on a rather large debt, because they're going to be the ones who are going to face the problems. If you're someone who hasn't touched your mortgage in 15 years and you're paying a 3% variable rate, because obviously a 3% variable rate is significantly higher than what you can get if you were to refinance tomorrow. If you've got, a 100 grand mortgage and you're coming towards the end, 0.25% isn't really going to make any difference to you. A 1% rise isn't going to make that much difference to you. But if you've borrowed on one of these cheapy variable rates of, 1.8, 1.9, 2%, and then you see 1% worth of rate rises, and you've stretched yourself, and you've got this big mortgage, and that's where things get a lot more challenging.
Yep, and that's precisely, again, going back to my case study from this morning, and by the way, I'm relaying this with permission. That's precisely the situation, because they bought basically, the height of low rates, big mortgage, highly leveraged. Income's not growing anything like what they thought they were, costs are rising, and now this talk of interest rate rises, and of course impossible to fix because the fixed rates are just already too high. So they've just got to sit there waiting for somebody to pull the trigger.
Well, it's an unenviable position. Now, I know some folks like that we end on this particular chart, so this is the cash rate futures chart for the RBA's cash rate. Now, I will say that this predates the hot CPI figures that were released last night. So this particular piece of data won't be released until later tonight. And basically it shows that the market is pricing in 7 hikes over the next 16 months, that we'll see 4 hikes by the end of the year. and the first hike fully priced in for July. But as I said, that may have changed. That may have been brought forward as the Fed becomes more hawkish as a result of the hot CPI data overnight.
Well, certainly the latest bond yields that I looked at were higher, and so I wouldn't be surprised to see that very strong. And remember, again, this is a market view, and it goes back to who's right, the market or the RBA, right? But I have to say, when markets around the world are all saying rates are going up, right, it's hard to see how Australia can isolate itself from those global forces, remembering so much of our economy is reliant on international funding and flows. And so whatever the Phil Lowe's of this world wants to do based on what's right for the local economy, this avalanche of higher rates around the world will probably cruel his pitch.
Well, that's what I find really interesting. Like, I put up a chart the other day on Twitter that showed wage growth over the various Anglosphere nations as of the latest comparable data, which admittedly was only to the end of the September quarter, because the ABS is unfortunately, lagging behind the rest in that regard. But Australia, out of the big four Anglosphere nations, which are Australia, Canada, the UK, and America, Australia has the lowest wages growth.
Yep. And
that makes me wonder, are we actually going to see this super strong wages growth that we've seen around the world? Is the resumption of immigration is the struggling economy, the struggling economic fundamentals, I should clarify by saying, is that going to weigh things down significantly enough for Lowe to credibly say, I'm going to keep it on hold, I'm just going to let the dollar get trashed, we're going to be on hold until, like August, September, October. And by then, it's entirely possible that something in the global economy or in financial markets may have broken as a result of rate hikes and deteriorating situation, and at which point all this becomes academic. So there are a lot of different possible outcomes. Sure, we could see rates go to the moon. We could see certain things. We could see, say, for example, the petrol price issue that we mentioned. If that keeps going up, Lowe's doesn't have a choice. But if we get a lid on it, and wages stay weak because of the weaker underlying economic fundamentals, who knows?
Right, and I'll just add one more factor. About 6 to 8 months ago, Lowe said that the migration coming in has a tendency to drop wages, right?
Yeah.
And so he was arguing that actually that could be positive wages. We know a lot of companies are relying on cheap labor, right? And will want to have people coming from overseas to work on the farms, et cetera, et cetera. So those factors could, as you say, keep the wages dial really low. And seeing as now he has anchored his whole strategy to wages growth, right? You just wonder whether you're right. In that case, he'll say, well, we can't move interest rates here because the wages thing has not worked. Now, here's a test for you. Where in the Reserve Bank mandate is wages growth actually pinned?
Yeah, as far as I know, it's not, is it?
It's not.
Well, there you go.
No.
Well, exactly. That's exactly what I was thinking in terms of that he has based the entirety of monetary policy now on wages growth, which means if all these normal government policy settings, if all of the tricky industrial relations things, all of the various, the immigration, everything else, if that conspires to keep wages within a reasonable band of 3%, all of a sudden, even if inflation is running at 4 or 5%, Lowe, at least in theory, has that potential, sort of narrative to lean on. Now, the big thing I think is going to be really interesting going forward is going to be the political side of things, because that's what's really lit a fire under the Fed's arse recently. It's not just the inflation, it's the fact that, on Capitol Hill, they're getting grilled and grilled big time. And so far, people here in Australia are just relatively, sanguine. They don't really care. But if things do start to continue continue to bite and people start to get annoyed and it starts to become a political issue, then all of a sudden you could have this really interesting thing whereby Aussies are going, you need to do something about inflation. And then Lowe's going to go, but that means raising interest rates. And at some point, if inflation keeps going, they're going to go, we don't care. Because most people, 80% of people, rates rise, no biggie. They've had a mortgage for years, or they don't have a mortgage, or they rent. They don't give a crap. But the 20% or so, I mean, I imagine you may be able to clarify that better than I am. Those people are the ones who are going to have a problem.
Yeah, well, 41% of borrowing households, right, which is, so 1/3 of the population basically have a mortgage. So of that 1/3, right, 41% of that 1/3. So it's not a large number.
No, not exactly.
But they're the ones that are absolutely exposed. But, you know, my view has been for some time that Lowe has this little door in the corner, right, which is emergency exit. And basically that emergency exit has opened the migration throttle, right, let people come in, keep wages low, argue like anything that wages is the only thing to actually focus on, right? And that then keeps some credibility intact for him. And he can say, well, you know, we haven't done what we should have done because, well, wages growth was the problem. So it's actually a perfect alibi. That's what I think's going on.
Well, I mean, I have heard anecdotes from within the RBA. I'm not going to say from who or from who about, but rest assured, you know, from a reliable source, that basically if trashing the dollar is an option, is a reasonable politically viable option for Lowe and for the RBA, they will choose that over raising interest rates if they have a choice, if they're given a choice.
Yep. Right. And then, so therefore it fundamentally comes back to how much pressure will be building from those international moves, which probably are now going to play through. What does that do to the financial flows in and out of the country? And those are the things to watch, in my view, because as the water pressure builds in all the other countries, right, it's going to spill over into Australia, right, because we're at the bottom, as it were, right?
Yeah, well, exactly. And the thing is, eventually the cash rate doesn't matter. Eventually the banks are going to do Lowe's job for him.
Yep.
You know, that we've already seen that with fixed rates going up. You know, sometimes they've been raised twice in a month, you know, or twice even in a couple of weeks in some cases, late last year. So eventually they're going to make the choice for him. But I mean, it's interesting because I can imagine if he is forced to raise rates, he is going to be one of the most unpopular men in the Australian history, because there are going to be a lot of people who are very angry at the fact that they have to pay more for their mortgage after he said, no, it's not going to happen until 2024 at the earliest.
Absolutely. And I'll just remind you as we come to the end of this show that the bank results that came out over the last few days, right, so pretty much all the majors and a few of the regionals reported, margin compression was the thing that was absolutely central. Now, they all dressed up their results with lowering bad and doubtful debts and making, you know, one-off things. But if you look at it in margin compression terms, right, they all are under huge amounts of pressure, right? The only thing that they can do is to try and hold deposit rates as low as possible and lift mortgage rates. So there is no doubt in my mind that we're going to see a lot more upward momentum in terms of mortgage rates out of cycle or whatever the RBA chooses to do, right? And that's the thing that, again, I think a lot of people haven't understood, that a lot of it is beyond the control of the central bank, right? It's actually much more to do with those market forces, the price of international money, and as you mentioned, the problem of the banks having to pay back that very, very cheap term funding facility, unless the RBA then turns around and says, well, we'll have to do a TFF Mark II. And I don't know that that's such a far-fetched idea.
No. Well, I mean, TFF Mark I went off without a dicky bird. And nothing, you know, it was a political and media nothing. People were just like, oh, well, they're giving $200 billion to the banks, yeah, whatever, you know. And I don't know. I mean, like in the US, trying to go, oh, we're going to go and give all this money to the banks, it'd be, you know, there'd be hell to pay. But here in Australia, we're going to give the banks another 200 billion in order to keep your rates low. I think I can imagine some people will be like, yeah, all right.
Well, banks are a charity, aren't they? I mean, surely, we should be supporting our banking system by giving them as much money as they want as at cheap rates as possible. Because isn't that in the interests of Australia and Australians?
Well, all I can say is if and when everything does blow up and we do see issues, can we please, as a nation, say to the banks, no, we're going to help, we're going to protect the depositors like we said we would, and all you shareholders who have been reaping all these dividends for all these years, you're going to pay.
Yep.
Your equity is going to pay, because that's the way it's meant to work, and that's the way it works in every other industry, and that's the way it's going to work in this one from this point onward.
Except that, of course, if you talk to international investors, they assume that the banks are a protected species in Australia, and they know that the government and the RBA will bail them out come hell or high water.
Have you actually seen some of those charts that they do of the different bank ratings? And there's actually little asterisks on some of them for Australia, which just basically says implicitly backed by the Australian sovereign. And they get a bump up in their credit rating as a result and save on funding costs.
That's exactly right. And that's why the margins of the banks here are so high relative to international. And that's, so we have a protected species, right? And the fact of the matter is that the banking sector is so large relative to the rest of Australia that they're too big to fail. As a result of that, basically, the political will is not there to do anything about it other than just to keep the system going. So at the end of the day, my view is that none of the big banks will ever fall over in Australia because they'll always be protected by the government.
Yeah, probably. But, a man can live in hope of a free market.
I know. Well, somewhere over the hill, we're in free market land, but that's a long way from where we are. Tarric, we've done way over our time, but very, very interesting conversations. Thank you very much for your slides as well. Very, very powerful information there. And we must do it again soon, as things are moving so quick, aren't they?
Well, they certainly are. I'm looking forward to it.
Thanks. Take care. Bye-bye.
You too, mate. Bye.